The majority of market analysis is focused on the critical question of timing, that is, attempting to determine when a significant market move is likely to occur. But Richard D. Wyckoff, in his scientific approach to speculation, was equally concerned with a second and equally important question: how far? To solve this problem of magnitude, of determining the likely extent of a coming price move, he turned to one of the oldest and most logical methods of chart construction, the point and figure chart. This largely forgotten weapon in the analyst's arsenal allowed him, based upon his own foundational law of cause and effect, to project the potential scale of a market move with a remarkable degree of mathematical logic. This study is a complete masterclass in the construction and correct interpretation of this unique and powerful analytical tool. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. And remember to return to the channel in difficult times when trading isn't well. To begin our study, we must first understand what a point and figure chart is, and more importantly, what it is not. Its unique value is derived directly from its unique method of construction, which is fundamentally different from the standard bar or candlestick charts that form the basis of most technical analysis. The primary purpose of a point and figure chart is to filter out market noise. It is a method specifically designed to eliminate the two most misleading elements of market data: insignificant price fluctuations and the distorting influence of time itself. Let us first draw a sharp contrast with the conventional bar chart. A standard bar chart is a record of price plotted against a constant interval of time. Each vertical bar on the chart represents a single fixed period, be it 1 minute, 1 hour, 1 day, or 1 week. A great deal of activity can occur within that single time period, but at its conclusion a new bar is drawn, regardless of whether the price has moved significantly or not at all. This means that a long period of sideways, meaningless price action will occupy a large and visually prominent space on a bar chart, purely because a great deal of time has passed. The point and figure method rejects this premise. It operates on the principle that the only price action worthy of analysis is a move of a significant magnitude. Time is irrelevant. A new entry is made on a point and figure chart only when the price moves by a predetermined amount. A stock could trade sideways for 6 months within a narrow range, and this entire period might occupy only 2 or 3 columns on a point and figure chart, correctly representing it as a period of equilibrium rather than a long drawn-out event. To construct a point and figure chart, we must first define 2 critical parameters. The first is the box size. The box size is the minimum amount of price change that we deem to be significant and therefore worthy of recording. The choice of box size is crucial and depends on the price and volatility of the instrument being analyzed. For a stock trading at $100, a common box size might be $1. For a stock trading at $20, the box size might be 50 cents. This means that for our $100 stock, we will only make a new mark on our chart when the price has moved up or down by at least $1 full. Any movement less than this amount is considered insignificant noise and is completely ignored. The second critical parameter is the reversal amount. The reversal amount defines how much the price must move in the opposite direction to warrant a change in the chart's direction. This is the key filtering mechanism. The standard and most widely used reversal amount is 3 boxes. Using our example of a $100 stock with a $1 box size, this would mean a $3 reversal amount. This rule dictates that as long as the price is rising, we will continue to add new marks in the current upward column. Any minor dips or reactions of less than $3 are ignored completely. It is only when the price reverses downwards from its peak by at least $3 full that we will end the current upward column, move 1 column to the right, and begin a new column of downward price action. This reversal amount acts as a powerful filter, eliminating all the minor, meaningless counter-trend reactions and allowing the analyst to focus only on the major, significant swings in the balance of supply and demand. Now that we have defined the core parameters, we can proceed to the practical construction of a point and figure chart. This exercise is essential for a full and intuitive understanding of its logic. The chart is composed of a series of alternating columns. A column of rising prices is represented by X's, and a column of falling prices is represented by O's. Let us use a hypothetical stream of daily price data for a stock with a $1 box size and a 3-box reversal amount. Assume the stock begins a rally from $45. As the price rises to $46, we make our first mark, placing an X in the box corresponding to 46 on our graph paper. As the price continues to $47, we add another X above the first in the $47 box. Let us say the price continues to rally, reaching a high of $52. Our first column will now be a series of 7 X's, filling the boxes from 46 to 52 inclusive. Now let us assume the price experiences a minor correction, falling from the high of $52 down to $50. This is a decline of $2. Because our reversal amount is $3, 3 boxes, this $2 dip is considered insignificant noise. We do absolutely nothing on our chart. The current column of X's remains in effect as the condition for a reversal has not been met. This is the filtering mechanism in action. Let us now assume the price continues to fall, reaching $49. The price has now reversed a total of $3 from its peak of $52. 52 to 51 is 1 box, 51 to 50 is a second box, 50 to 49 is a third box. The condition for a reversal has now been met. We therefore end our column of X's. We move one column to the right on our chart, and we begin a new column of O's by placing an O in the box for $51, then another O below it for $50, and a final O for $49. We are now in a confirmed column of falling prices. We will continue to add O's to this column as long as the price continues to fall, and we will only begin a new column of X's when the price rallies by at least 3 full dollars from its lowest point. The result of this unique construction method is a chart that provides the analyst with a clean and uncluttered view of the market's true structural condition. The long, alternating columns of X's and O's clearly delineate the significant uptrends and downtrends. The minor, confusing, and often misleading price fluctuations that clutter a standard bar chart have been completely filtered out, allowing the analyst to focus only on the meaningful movements. Furthermore, this method of construction creates exceptionally clear and logical levels of support and resistance. A long row of O's at the bottom of a series of declines forms a clear support level, while a series of X's at the top of multiple rallies forms a clear resistance level. This simplified and logical representation of the market structure is the foundation upon which the Wyckoff method of point and figure analysis is built, and it is the key to unlocking the chart's unique predictive power. Now that we have established a firm understanding of how a point and figure chart is constructed and why its unique methodology is so effective at filtering market noise, we can proceed to the core of this study. We now move from the simple mechanics of chart construction to the profound and unique method that Richard Wyckoff employed to project price targets. This is the practical application of his foundational market law, made possible only through the clear, logical lens of the point and figure chart. This is the method of the horizontal count. The true genius of applying the point and figure method, as Wyckoff taught it, lies in its extraordinary ability to visually and mathematically represent his first and most important fundamental law, the law of cause and effect. This law states that a significant market move, or effect, cannot occur without the prior preparation of a commensurate cause. The subsequent effect will be in direct proportion to the preceding cause. In the context of our analysis, the cause is the long and often complex period of accumulation or distribution that takes place within a trading range. It is the period where the composite operator is either absorbing shares to prepare for an advance or distributing shares in preparation for a decline. On a standard bar chart, this cause-building process can appear messy, chaotic, and difficult to quantify. The sideways price action can be confusing, and it is difficult to measure the extent of the professional campaign that is underway. The point and figure chart, however, by its very nature, transforms this seemingly random sideways movement into a clear, orderly, and most importantly, measurable horizontal formation. The back and forth action of the trading range creates a series of alternating columns of X's and O's, forming a distinct horizontal band of congestion on the chart. The horizontal width of this formation, specifically the number of columns it contains, is a direct, quantifiable measure of the cause that has been built. It is a visual representation of the energy that has been expended and stored up during the preparatory phase. To use a simple analogy, this horizontal count is like measuring the amount of fuel being loaded into a rocket before its launch. A short, narrow accumulation base, one that consists of only a few columns on the point and figure chart, is like a small amount of fuel. It can be expected to produce only a modest and limited price move. However, a long, extensive, and well-formed accumulation base that stretches across many columns on the chart is the evidence of a massive cause being built. It is like a massive fuel tank, and it suggests the potential for a very large, powerful, and sustained subsequent uptrend. The Wyckoff method of horizontal counting, therefore, is the process that turns the abstract concept of a market cause into a concrete, countable number that can be used to project a logical price objective. We will now proceed to the mechanical process of conducting this horizontal count. This is a step-by-step masterclass in the practical application of the principle. It is a logical and repeatable process that, when correctly applied, can provide the analyst with an invaluable guide to a potential trade's objective. Let us first consider an example of an accumulation base. Our first step is to identify a completed accumulation pattern on the point and figure chart. This will appear as a well-defined horizontal trading range that has been preceded by a significant downtrend. Within this range, we should be able to identify the key Wyckoffian events, such as a selling climax, secondary tests, and a final shakeout or spring. Our second step is to establish the count line. The count line is the horizontal price level along which we will measure the width of the cause. For an accumulation base, the count is taken along the price level of the last point of support. The last point of support is defined as the last significant low point or reaction that occurs following the spring or shakeout, just before the price begins to leave the trading range to the upside. We choose this level because it represents the final springboard from which the major advance is launched. It is the last and most definitive point of support in the entire accumulation structure. Our third step is to perform the horizontal count. We place our starting point at the far left of the trading range and count every single column, including both X columns and O columns, that touches or crosses our established count line, until we reach the far right of the trading range, just before the price makes its decisive jump across the creek. It is a simple, methodical process of counting the horizontal units that make up the cause. Our fourth step is to apply the formula to convert this horizontal count into a vertical price projection. The formula is as follows. The number of columns is multiplied by the box size, which is then multiplied by the reversal amount. This product equals the potential price move. For a clear example, let us assume we are analyzing a stock with a $1 box size and a standard 3-box reversal amount. If our horizontal count along the last point of support yields a total of 25 columns, our calculation would be 25 columns multiplied by $1 multiplied by 3. This gives us a total of $75. This $75 figure represents the total potential energy or effect that has been built up during the long cause of accumulation. Our fifth and final step is to project the price targets. Wyckoff's method allows us to project two distinct targets from this single count. The first is the minimum price objective. This is calculated by adding the result of our formula to the price level of the count line itself, the last point of support. This gives us the most conservative and high probability target for the move. The second is the maximum price objective. This is calculated by adding the result of our formula to the price level of the absolute low of the entire accumulation base, often the low of the selling climax or the spring. This gives us the maximum potential for the move, representing the full expenditure of all the energy built during the cause. The professional operator uses these two targets to create a logical target zone for his campaign. This same process works as a perfect mirror image for calculating downside price targets from a distribution top. The analyst first identifies the completed distribution pattern on the point and figure chart. He then establishes his count line, this time at the level of the last point of supply, which is the last significant rally peak before the price breaks down out of the range. He then performs the horizontal count of the columns along this line. He applies the same formula. Number of columns times the box size times the reversal amount. Finally, he projects his downside targets by subtracting the calculated potential from the count line for the minimum objective, and from the absolute high of the distribution top for the maximum objective. Wyckoff's point and figure count is a uniquely logical, almost mathematical method for setting price targets, directly expressing his core laws. But other market masters approach the concept of how far a move could go very differently. Richard Dennis and his turtles, being pure trend followers, used no price targets at all. Their system was designed to ride a trend until a trailing stop was hit, however far that might be. Nicholas Darvas used the tops of his boxes as stepping stone targets, moving from one price level to the next. Bernard Baruch would often set his targets based on a deep fundamental analysis of a company's potential earnings or intrinsic value. To understand these diverse approaches to profit-taking and trade management, we created our new channel, Trading Insights. It explores the philosophies of these legendary speculators, showing that there are many paths to success. We invite you to subscribe and watch. The link is in the description. The mechanical technique of the horizontal count is a powerful and logical tool. It provides the analyst with a concrete mathematical method for estimating the probable extent of a market move. However, any tool, no matter how powerful, is only as effective as the judgment of the professional who wields it. A purely mechanical application of this or any other market technique, without the guiding hand of sound, experienced judgment, is insufficient for consistent success. We must now therefore transition from the mechanics of the count itself to the art of its practical application. We must understand how to integrate this unique tool into a complete and coherent trading campaign. The first and most critical principle of practical application is to understand that the point and figure chart is not a standalone trading system. It is a supplementary tool, a second and equally important lens through which to view the market. Its purpose is to confirm, to complement, and to add a vital dimension of understanding to the primary analysis that must always be conducted on the standard bar chart with its corresponding volume. These two types of charts are not in competition with each other. They are partners in analysis. They are designed to answer two different but equally essential questions. The bar chart, when analyzed with its accompanying volume according to the principles of Richard Wyckoff, is our primary tool for judging the character and the timing of the market's action. It is on the bar chart that we can see the subtle and detailed story of supply and demand as it unfolds day by day. It is here that we can identify a climactic selling climax, the quiet absorption of supply, the final deceptive shakeout, and the powerful sign of strength. It is on the bar chart that we can precisely time our entry at the last point of support, based on a meticulous reading of the harmony or divergence between effort and result. The bar chart tells us what the market is doing right now, and it provides the evidence we need to determine when to act. The point and figure chart, however, answers the second great question: how far? It is our primary tool for judging the potential magnitude or extent of the move that the bar chart has signaled is about to begin. The horizontal count taken from a long point and figure accumulation base gives us a logical, evidence-based reason to believe that the coming up trend has the potential to be a truly significant and profitable campaign. It provides a roadmap for the journey ahead. It helps us to differentiate between a minor rally that may have limited potential and a major bull move that has been fueled by a massive cause. Therefore, the professional speculator uses these two tools in tandem. He uses the bar chart and volume to select his moment of entry with precision, and he uses the point and figure chart to select his campaigns with wisdom, focusing his capital only on those opportunities that, according to the horizontal count, offer a potential reward that is substantial enough to justify the inherent risks. With this understanding of the synergistic relationship between the two charting methods, we can now explore the critical nuances of interpretation that elevate the use of the point and figure count from a simple mechanical exercise to a true professional skill. The calculated price objective is a guide, a potential, not an absolute guarantee. Its projections must always be weighed and considered in the light of the market's own, unfolding day-to-day action. One of the most practical applications of the method during an ongoing trend is the use of partial counts. A major uptrend is rarely a single, uninterrupted advance. It is typically composed of a series of advances, followed by periods of consolidation or reaccumulation. These reaccumulation phases are, in effect, smaller trading ranges that form along the upward path. They are periods where the composite operator absorbs the shares sold by early profit takers and prepares the stock for the next leg of its journey. These smaller consolidation patterns are clearly visible on the point and figure chart, and they can be counted in the exact same manner as the initial primary base. A horizontal count taken from a reaccumulation area will provide a shorter-term, intermediate price objective. This skill is invaluable for managing an ongoing campaign. It allows the operator to set logical, intermediate profit targets and to better understand the probable stepping stones on the path toward the larger, ultimate objective that was calculated from the initial base. A second critical point of judgment is in understanding what it means when a price objective is not met. Let us say that our count from a major accumulation base gives us a minimum price objective of $80. The stock breaks out, begins its advance, but the character of the trend begins to show signs of weakness as it approaches $70. The rallies begin to occur on diminishing volume, and the reactions become sharper. The stock then fails to reach the $80 minimum objective and begins to form a new distribution top at the $70 level. This failure to achieve the projected thrust is a powerful warning sign. It is a form of effort versus result on a grand scale. The great cause of the accumulation base has failed to produce its expected effect. This is a clear indication that a significant and unexpected source of supply has entered the market, and it is a signal for the professional operator to immediately re-evaluate his position and to consider taking his profits regardless of the original projection. The price objective is a guide, but the market's own current action is always the final arbiter. Finally, the professional operator uses these price objectives not as a single all-or-nothing exit point, but as a logical zone for scaling out of a position. An amateur, upon calculating a price target of $80, will often place a single sell order at that price. This is a rigid and unsophisticated approach. The professional understands that the price objective represents a zone of potential supply, an area where the move is likely to meet resistance. He will therefore use this zone to his advantage. As the price enters the lower end of the projected target zone, he may begin to sell a portion of his holdings. As the price rallies further into the zone, he may sell another portion. This method of scaling out of a winning position allows him to systematically realize his profits, to reduce his risk as the trend becomes more mature, and to avoid the emotional trap of trying to guess the exact, final high tick of the move. This video has taught you the powerful technique of point and figure counting. But a technique without judgment is dangerous. Richard Wyckoff's essential work, How I Trade and Invest in Stocks and Bonds, is the manual for developing that professional judgment. It doesn't just show you patterns. It teaches you the foundational laws, cause and effect, supply and demand, that make those patterns work. You will learn the why behind the how. In the book, Wyckoff details his own campaigns, showing how he integrated his analysis of a stock's character, its management, and the market's tone with his chart-based projections. If you want to transform this technical skill into true market wisdom, you must understand its philosophical and strategic foundations. This book provides that indispensable context, teaching you how to think like a professional. In our conclusion, we have established that the point and figure chart is Richard Wyckoff's unique and logical tool for the practical quantitative application of his great law of cause and effect. It provides the analyst with an invaluable roadmap, a logical guide to the potential magnitude of a trading opportunity. This knowledge transforms the nature of a speculation. It allows the professional operator to better manage his position, to set logical profit objectives, and to be psychologically prepared for the full extent of a major market move. While the bar chart with volume tells you when to act, the point and figure chart tells you what you are acting for. It provides the logical justification for exercising the patience required to ride a great trend to its profitable conclusion. The mastery of both of these essential charting tools is a critical and necessary step on the path to becoming a true scientific speculator of the stock market.